Biz Talk Today TV. Welcome everyone to Buy, Hold, Sell. I am your trader Todd Schoenberger, and I am joined by my friend and co-host Tobin Smith out in sunny and hot Scottsdale, Arizona.
Yeah, baby.
That's right. And with us today is Megan Horneman. She is the CIO of Verdence Capital Advisors, located in Baltimore, Maryland, my hometown. Megan, welcome to Buy, Hold, Sell.
Thank you so much for having me.
Absolutely. So we got to talk about, we'll get into the Ravens and the Orioles later on in the show, ladies and gentlemen. But right now, we're going to talk about
aren't we trying to have good ratings, Todd?
Isn't that really our
not
goal? Much to talk about there.
There you go. Well, we'll get into all of that later on. But right now, last week, we saw the Fed they did what they were expected to do: cut interest rates. They cut by a quarter of a percent, 25 basis points. The outlook also is showing us some indications that we received that they will be cutting perhaps even more as we proceed in the final two meetings this year. But you have a different outlook on the Fed, Megan. Can you explain to the audience, because the investors really want to know, should they continue on with this bull rally?
Yeah, I think from the Federal Reserve perspective, they delivered what the market was expecting. I think they buckled a little bit to the market, but let's keep in mind, they're cutting interest rates and the market is expecting them to continue to cut interest rates in a time when we're sitting here at record highs in many different asset classes. The economy isn't deteriorating. In fact, I think the Atlanta Fed is tracking about a 3% GDP for this quarter. Earnings are still growing strong and inflation is moving higher. So I'm not going to do the job of the Fed. I think some of the labor market data did warrant maybe some tweaking of monetary policy, but I don't agree with the markets and the equity markets on how optimistic they're getting about what flexibility the Fed has.
Hey, Morgan, what do you, Megan, I'm sorry. GDP now, I've been a big fan of. I was there from the beginning when they put that formula together, et cetera. It gets crapped on all the time, like it's just some airy-fairy thing that was invented, but it's been right, has it not?
Yeah, it's real time and it changes every day. So it's taking into consideration all of that economic data that we try and, siphon through to figure out where is the economy really going. And it can change with one bad reading on one report. We do have to realize that. So it can be very volatile, but yeah, it's tracking that real-time data. So it looks as though we will be producing, somewhere between that 2.5% and 3% growth. The consumer still is the unknown as we go forward. But, what we saw with that retail sales, even though it's not inflation adjusted, we remind everybody that it's not an inflation adjusted number. It looks like we're still producing, decent economic growth, but the Fed is cutting into that. And what's even a little bit more concerning to me is the markets take so much into those, summary of economic projections. But if you look at those summary of economic projections, they revised since June, the unemployment rate lower, they revised growth higher, they revised inflation higher, but yet now they're expecting more rate cuts than they were. It doesn't make sense. So I think the market's reading into things that can change very quickly too. They can come out in the next meeting the next time they release those projections, and that can change. And now we're looking at multiples on, for example, the S&P 500, very stretched in my opinion.
Hey, Megan, the other one that gets me always is, we talk about a lot on the show, is the top 20% of households by income now are for essentially not on just consumables, but on discretionary spending. We're like 79% in the last quarter. And so if the market, for whatever reason, goes south, doesn't some of that spending go south too?
Absolutely. And you can look at things like margin debt or the amount of free cash in accounts. This is all really stretched. So if this market goes south, we could end up in that vicious circle where you have to have panic selling to meet things like margin calls, or panic selling where, hey, it's been a great year. We're going into the end of this year. Let's take some profits off the table. 2026. We're not so sure how that's going to work out, what the Fed can do, what inflation's going to do. So let's take some profits off the table. This is something that you can see feed on itself and can create at easily a 5 to 10% correction.
Yeah, and the cash number, I keep getting this, but there's $7 trillion of cash on the sidelines. Can you help me understand that?
Yeah, let's keep in mind that we have yield in money markets now. So there, again, the
Yeah.
Fed cut interest rates, so it's lower than it was a few months ago, but you are getting paid just to sit there with cash. So I think there's this thought that all this money is going to enter the market. I think that there still will always be some level of that. And let's keep in mind that there was so much money and so much cash in the system after the pandemic. We've worked through a lot of that, but if you look at something like the money supply, that's still rising. So there still is a lot of money out there. Doesn't mean it's one for one. It's automatically going to enter the equity market.
Well, that's a good point. The other one that gets me. So we run money for individuals and some family offices, right? I'm getting 5.1% in my Schwab money market account for doing nothing, and I can't really charge a client investment management fee for being in cash, but we do because that's an allocation as well.
Right.
But I'm just to your point. So the zero risk 5% before inflation for a lot of people, particularly people who are older, et cetera. They're not buying stocks. They're staying and getting that money. I mean, have you found that with your clients?
Our recommendation is to have a healthy cash position, regardless of the age. And that's because the valuations in the market right now, there's nothing that's compelling to us. When we look at investments, we really like to look at investments that are fully reflecting any of the downside risks. We're cautious in the near term. It doesn't mean that we're not constructive longer term. We still think, for example, technology will continue to evolve. The AI trade will keep going. But I think right now, when you look at valuations, you're exactly right. If you can earn 4.5%, 5% in a money market and wait till things get a little bit more attractive, then that's when you allocate some of that. But you're not doing any harm by sitting there, earning that cash right now, sitting on the sidelines, being a little bit more cautious.
So we started Q3 though with the expectation that things were about to fall apart because everybody was expecting the price increases from the tariffs that were going to directly impact the consumer, and it's actually been just the reverse of that, and we had a great Q3. Now we go into Q4 next week. What's your expectation for the final quarter of the year?
I think it's going to be very choppy. I think investors need to really hold on here. This rally we've seen, this day after day record highs, I don't think that's going to continue through the fourth quarter. And I realize that we're past the negative seasonality period of the year. But let's be honest, that's just history. We're looking at history. There's always been times in history where that also
October always sucks. That's my rule.
Especially when you're coming. I mean, I don't want to say you're coming off of now the third year of very strong equity returns. There is a period where people may just need to take some of that money off the table. I think that when you look into next year, we have a midterm election coming up next year. We do have a tax package that is beneficial for businesses, but there still is that inflation component that really keeps us up at night, and everyone's ignoring that. We talked about in a lot of our weeklies that inflation acts on a lag. We saw the initial 10%, blanket tariff that we had. That did really start to filter in until June, July data. So now that we are past that August 1st and we have higher levels of tariffs, that's stuff we won't see until really November, December in that data. So the markets are pricing in that we're in this perfect economic, this perfect earnings, this perfect, inflation environment, this perfect picture where the Fed can cut rates with everything else perfect, which makes no sense to me because typically they're not cutting rates if everything else is perfect. So I think there's just so much euphoria in the market right now. This is when we do tend to see pretty sharp periods of volatility.
Hey, Megan, here's a real scientific deal here. So this is the new high list on the Wall Street Journal. Mm-hmm. And I'm very proud to say that literally every one of our technology stocks hit a new high on Friday, on yesterday, and today. Mm-hmm. Now, that's what worries the crap out of me. I mean, literally, we have new 52-week highs in our, we call AI ecosystem growth portfolio. We're going to run out of people to buy, aren't we? Mm-hmm. Or is it? Or is the allocation just? Where does the money keep coming from? That's what I'm trying to ask.
Right. Well, eventually, people will want to see the earnings. All this spending being translated into earnings. So there will be a period of time where people say, okay, we'll just keep buying because the future of AI is here. This is going to run everything. But we still have a lot of infrastructure that needs to be built to support this AI. And then investors that are paying for your example,
Yeah.
30, 40 times earnings, they're going to want to see that this is translated into earnings, and they're not going to be as forgiving if it is not. So I think that the next couple earning seasons will really be something that we have to keep an eye on. And let's keep in mind that we kick off earnings season 2 weeks from now, really.
Yeah.
Yeah, October 14th.
Yeah.
So with that though, hold on, Toby. So with that, to follow up on the earnings side. So with, as you know, inflation, that does help the top line number for companies. So from an earnings standpoint, higher earnings should result in higher stock prices. So you have a rising market, but in your scenario, you're suggesting that things may be choppy, may not be as great as they seem, I guess, from the macro view. So where's the give and take there? There's got to be a balance. So eventually something, either the economy will get to a point where it is healthy, but then the stock market's going to drop. Which one is it?
Right. I think that the stock market's going to drop. There is a point where it is healthy if they're passing it on. But what we've been seeing in some of the recent economic data is the companies are absorbing some of this. So that's going to hit margins.
Mm-hmm.
There is room for them to hit margins because we're sitting here with margins near a record high. Earnings profits are at a record high. So there's room for companies to take some of that. But I do think we have to go back to that saying the cure for high prices is high prices. And eventually the market will buckle. You are seeing consumers getting squeezed. This isn't like we're hitting, 3% inflation just one time. We've been consistently 3% or higher for a long time now. We're going into, we're going into the 6th year after the pandemic, the 4th year after we really had that 2022 inflation scare. This is compounded and compounding, where consumers are really feeling this, whether you see that in the stock market, not necessarily, but consumers are feeling this inflation. Eventually they're going to get squeezed to the point where they just say, we're done.
Hey, Megan, I'm just looking at some numbers as well. I'm shocked to say that our gold miners and silver miners have out-earned everything for us in the last 6 months. The dollar's down 11% against money. Any thoughts on that? I mean, I'm trying to. People are texting me saying, "Toby, how is it that the GDXU is up 175% in the last 12 months?" I said, "Well, it's 3 times the miners, and the miners sell at a 40% discount to the gold they have. What say you?"
Right. I mean, I think that there is a genuine concern about the viability of the dollar for the long run. So you're seeing things like gold, like silver, anything else that's a store of value, rise and hit record highs. And we understand that the deficit is a massive problem. This is something that the government just keeps kicking down the road. I don't fall in that camp that the dollar is going to lose its reserve currency. Will there be some diversification? I think you're seeing some of that with gold and silver, but I still think the dollar, while it's down, we're at the worst start to a year, I think, since the 1970s.
Yeah.
It is but we've also been in a dollar bull market. Really, I mean, there's been several periods of like 15% pullbacks, but we haven't really truly hit a bear market in the dollar since before 2010.
Yeah, I know.
It's been
I was the only one here alive and working in 1975. Okay, and it was when you went to the gas to go fill up your gas tank, and you're like, oh, I mean, I'm like 19 or 20 or something. But I sure hope I have $50 to put 10 gallons of gas in my tank at $4.50 a freaking gallon.
Right. Right.
Megan, on that gold trade though, I mean, is it one of your favorite themes going into the final quarter?
The only thing about gold, and yes, we probably missed that trade in this big rally. Gold is highly speculative as well. You could be one tweet away. You could be one political situation away from gold correcting, 5 to 10%. So I still stand by the U.S. dollar. The money markets sitting here are in U.S. dollar based. I think we'll look for opportunities if gold gives us a little bit of a pullback, but it's just such a speculative trade that and it is a better speculative trade than Bitcoin. Don't get
I
me
was
wrong
going to
on
say,
that.
isn't gold the real Bitcoin?
Gold is definitely got a store of value you can touch. So I do believe it's much better than Bitcoin. But if you look at it as compared to the dollar, I wouldn't necessarily pump your money into gold here for the rest of this year. Instead, the dollar still does benefit on flight to quality. It
Hey,
still does.
also silver. I mean, I think people have sort of missed the point that there's something like 42 kilos of silver that goes into every data center.
Right.
And there's, the reserves have been tapped out and China's not shipping us. So, hey, I say look into silver a little bit as well, because it's not a reserve currency. The central banks aren't buying it. But to make a freaking, connection in a data center, there's a lot of silver in there.
Yeah, there's a lot of metals in all of that.
Yeah.
That's why so the AI trade is the direct beneficiaries, your semiconductors, your chips, all this stuff. That's, I think, priced in, that's done. You got to start looking now, what's the secondary impacts, whether it's software, whether it's infrastructure. That's a huge one. And it's not just because of AI. Infrastructure has been a theme for a very long time, but we do need the infrastructure to support AI. Those are the areas that we're looking at if you really want to get into that AI trade. And there will be metals also
No question.
that will have to be used for this.
So sticking to the commodity theme, though, what about electricity? Seems like, because you mentioned AI and the infrastructure, this seems to be the best place for investors to consider. Do you have any opinions?
Yeah, I do. Electricity, obviously, that's something that is needed for the AI trade. But I think there's other ways. I'm not going to go out and buy utility companies. That's not something that you'd want to invest in unless you're very worried about the market in the fourth quarter. But even utilities are trading. They're not trading at a discount. Look at other resources, natural resources, things that eventually people will find alternative resources that can be used to build some of this.
Copper. Okay. I'm telling you, we're long copper too. I mean, it's unfortunately they just had a giant crash in one of the largest copper mines today that took about 8% of the copper out of the market. I'm with you on the fact that I sort of call it the tertiary or the secondary plays. Because everybody's in all the primary plays. I mean, when you look at the allocations, if you look at, I know you guys use managed accounts for various people. If you look at the top 100 mutual funds, the top 100 ETFs, et cetera, everybody's in everything. Maybe they were dumb and they didn't buy Broadcom because they don't understand what an ASIC is, okay? But, the retail investor is the one who's pumping more money into the stock market. Are you long any brokers or financial services in your matrix?
So we do have a value tilt to our portfolios right now because growth is so expensive. So you will find quite a bit of the financials in that area, whether it's the large cap value, even some of the small cap. And that's, not just because of diversification away from some of the expensive tech names, but there is the deregulation, that we're dealing with right now. The yield curve, there is, we have a sloping yield curve. So there is a lot of the M&A activity that we think will continue over the next year. These are things that should benefit a lot of those big banks.
Yeah, IPOs too. I mean, again, we are long Goldman Sachs and Morgan Stanley simply because they're number one, number two in IPOs. But what about IPOs? Do you, in your strategy, those stocks wind up in the portfolio, but you don't have a discrete IPO type approach?
No, we don't do that. We leave that, as I mentioned, to the separately managed accounts that pick our stocks for it. So they'll go in. I just, buying in a hot market already, a hot IPO at an elevated valuation, I think there's just probably better opportunity when it comes out on the secondary.
So what you're saying is you don't really have a Bitcoin stable coin allocation at this time, Megan?
No. Not at all. If you want to, you can buy T-bills and get the same thing pretty much as a stable coin, because that's what they're
Right.
using as collateral. Bitcoin, if you don't want to sleep at night, go ahead, go for it. You can buy it at these levels. But we don't see Bitcoin as a part of our asset allocation at all.
And Megan, before we let you go, I want to ask you about real estate. With the Fed cutting rates, and I know the long end isn't moving just yet.
Yeah.
But what are your thoughts on the sector? Is this a good time to consider it?
Well, I think from an economic standpoint, I mean, we got some of the data today, and you're seeing, that there is that people are coming back in. I think home builders are starting to offer incentives here to get people into the housing market. But I think
incentives to go to Baltimore? Come on, man.
Come on, Toby.
Come on. The Ravens will turn it around. Come on. We know they will, right?
Yes.
We have Lamar Jackson. Come on.
Yes. That's right.
But the real estate, if you're looking at publicly traded real estate like the REIT market, just remember they're very interest rate sensitive. So if we get a spook in the interest rate market, which is highly likely, especially on the long end with the deficit that we have right now, that could impact that portion of it. Instead, look at the private market. The private market still does have opportunity in real estate. That's where we would be invested in if you want to go into the real estate market. I still think the housing market has a ways to go. We're still short a lot of houses. Prices are not that cheap in order to build houses. We saw it today. Prices went up. The month supply is back down to low levels. So we're still kind of in this tug of war of being able to get housing affordable, and the Fed can't build houses.
Yeah. Well, I
got
the numbers today. Yeah, I got numbers today that 65 or 68% of homes that are owned by people have a 3% mortgage rate. So they're not going anywhere.
Right,
Another 18 to 24% are actually free and clear. They ain't going nowhere.
Right.
So,
there's only like 20%, I think it was 18% that have a mortgage above 6%. And with the 30-year mortgage rate at 6.39 today, it's still got to come down a ways to even get refinancing activity there.
What would get the 30-year or the 10-year down in rates? Because the Fed so far seems impotent.
Yeah, and unfortunately, I think it would have to take some intervention into the yield curve, which I don't believe in, but that's what would have to happen in order to get some of those long-term interest rates lower. And again, that would be putting a Band-Aid on a bigger problem. Let the market work this out.
But how would they do that? And how would they intervene to get rates down? Are we talking about the Fed doing it or what?
The Fed. And again, the Fed's that's not their job. That's not what they're going to, that's not what they're meant to do. I don't think that the federal government I don't think that's obviously their job. We've seen the private market come into certain pockets of around the United States, and they're just driving housing prices higher. So unfortunately, this is a problem. It's going to take a long time to work itself out. And just thinking that the Fed cutting interest rates a little bit is going to solve this problem, that's not necessarily the case. It's going to have to be a bigger fix that's beyond my pay grade.
Quantitative easing for the 10-year. That would be something else.
Yeah, that would be something else.
We'll see. So, Megan, we're going to leave it there. We know you have to get ready for the Ravens game this Sunday because obviously you're going to beat the Kansas City Chiefs.
Obviously.
You
want to bet, Todd?
I'll take that bet.
I only watch when I know the outcome.
All right.
Megan, $1.
Thank you so much for joining us today on Buy, Hold, Sell. We got to have you back before the end of the year, though. There's so much to talk about as we go into 2026, but we appreciate all your thoughts today.
Great. Thank you guys for having me.
Absolutely. So on behalf of Megan Horneman and Tobin Smith, I am Todd Schoenberger. Thank you once again for joining us on Buy, Hold, Sell. We'll catch you next time. Take care. All right. We are out. All right. Thank you, Megan.